Ladies and gentlemen, thank you for joining us today for the sixth session of the 2025 M&A Academy series. Whether you're tuning in from Mumbai, Madrid, Melbourne, or somewhere in between, a very warm welcome to all of you. My name is Rabindra Jhunjhunwala, and I will be moderating this session. A little bit about the webinar and agenda. Our M&A Academy program was launched to demystify M&A for practitioners, in-house teams, and even deal-curious professionals. Whether you're looking to make your first acquisition or you've survived a few already, this platform is designed to offer practical insights, not just legal theory. Today's topic: how to successfully do cross-border acquisitions. We've all seen the headlines: big name deals that start with champagne and sometimes end with litigation. The reality: cross-border M&A is a thrilling but tricky ride. Our panelists, very learned partners from around the world, will help you navigate that journey today. Here's how we're going to run it. We will dive into a panel discussion peppered with some real war stories from the trenches. Then we'll move to a Q&A. We've already received a bunch of questions, but if you have more, please feel free to drop them in the Q&A window. And of course, in case we can't get to your question, don't worry, we'll follow it up by email. After the session, we'll also send you a summary note and a recording, so you really don't need to scribble furiously during the session. M&A is the heart of our firm. More than half our partners focus on M&A across sectors and jurisdictions. We've seen deals go smoothly, and we've seen deals, let's say, get educational. Let's be honest, cross-border M&A is where things really get spicy. It brings incredible opportunities, new markets, innovative technologies, global talent, but it also comes with a suitcase full of legal, regulatory, operational, and cultural challenges. In my career, I've seen deals fall apart at the altar because one party expected board control while the other expected complete independence. I've seen deals getting ambushed midway by regulatory surprises like indirect transfer tax or the joys of CCI filing or going for a regulatory approval, uh, and sometimes triggered by a small Indian target, but in a very large global group. We've seen deals lose steam post closing due to lack of integration planning. We'll figure out after the deal is done never really works. So today, we're going to unpack why deals stumble, how to anticipate the blind spots, and what successful acquirers do differently, right from the diligence table to day one and beyond. By now, you received our panelist bios via email, and if you've skimmed them, you know we have a stellar lineup of M&A heavy hitters joining us today. I'm not going to get into long introductions, but let me just say they've closed deals on every continent except perhaps Antarctica, and maybe someone's working on that one too. So please welcome Indranil Ghosh from Kingwood and Mallesons, and my very own partners Karun and Anuj, who are based in Singapore. Unfortunately, as you can see, we don't have Edwin, who was going to join us from Debevoise and Plimpton. But I'm going to throw a surprise and ask Indranil, Karun, and Anuj the questions that I had planned to ask Edwin. So, gentlemen, thank you. Thank you very much for being here from all of us. And let's dive straight in. Indranil and Anuj, if I can kick off things with you, let's do a quick pulse check. How are you seeing cross-border M&A activity involving specifically India at the moment, and what sort of trends or sectoral themes are coming up more often in your conversations? Indranil, would you like to go first?
Thank you. Thank you, Ravindra. And firstly, thank you very much for having me. So for people who do not know me, I think it's worth mentioning where I sit. So I sit in Singapore, and we cover from Singapore cross-border M&A deals across the region, including India. So why this is important is the flow that we see is into India. Being in Singapore, it's such a important hub. We see flows from Japan, Korea, Australia, Southeast Asia. So it's across the Asia Pacific. And that deal flow has held relatively steady. And in fact, it's evolving in a structurally significant way. On the inbound side, a deal flow from Japan, Singapore, and South Korea remain active, especially in manufacturing, electronics, and logistics. The trend underpinning this is the China Plus One strategy, which is what we are seeing is more than just talk. We are seeing real capital being deployed. For example, Mitsui and Marubeni have expanded their India presence through JV-led platforms. The other pillar that's supporting a strong inflow into India is private capital. Regional PE and sovereign investors are increasing their India allocations, especially the key themes that we see are digital infrastructure, energy transition, including green energy and EV ecosystems. And they're looking at India not just for returns, but for strategic scale, like data centers, solar storage, mobility. On the outbound side, we see Indian corporates also expanding into Southeast Asia, especially in pharma, industrials, and one of the reasons why this has been the case is in jurisdictions like Australia, for example, legal familiarity, enforceability of contracts, IP protection make them an attractive first-time outbound um, target destination. So I'll probably pause there and maybe throw it back to you, Ravindra, and Anuj, to share your
Thanks.
thoughts.
Anuj, perhaps maybe you want to add a few things, and thanks, Indranil.
Uh, Thank you, Rabindra. I mean, Indranil's covered a large part of it, and what I see is not very different from what Indranil mentioned. I should also clarify for our audience that while Karun and I, both of us, are based in Singapore office of Khaitan, even in our Singapore office, we focus exclusively on Indian laws and cross-border deals that we do out of here, again, should have some Indian nexus. Uh, if I have to just supplement to what Indradil mentioned, uh, it's still very inbound heavy is what we continue to see. We continue to advise multiple sovereign funds on large scale platform setups. Several are betting on data centers, hospitals, logistics, diagnostic centers. Uh, a new trend that we are seeing in recent times is a wave of multinational corporations cashing in on their India assets. Just last week, AkzoNobel agreed to sell controlling stake to JSW Paints for about $1.5 billion. We've seen similar deals with British American Tobacco exiting out of ITC. A very large deal happened in March early this year. We have seen an announcement by BP saying that they want to exit their lubricant portfolio. They run a very large listed business in India called Castrol. Whirlpool has announced exit from the India business. So this is a unique trend that we are seeing, which also sort of indicates perhaps very rich valuations which continue to be available in India. But broadly, other than that, I think Indranil covered it all.
Thank you very much for the perspective. It's very useful to get a sense of how market sentiment is evolving and which areas are drawing sustained investor interest right now. I will add to what Indranil and Anuj mentioned, and I would say a lot of these exits are really monetizing, if I can use the word, to encash the value which they're getting. And second point which I would like to make is many of the MNC subsidiaries in India are also finding ways to list and in cash. And you have the Hyundai, which IPO which happened several months back, and again a very sizable one. And the last one that I would mention is a lot of carve out restructuring which is happening overseas, where we see India play out. So with that, building on next set of questions, and again maybe I can go back to you, Indranil and Anuj, more of a follow up. Are there any broader geopolitical or global macro trends that you are feeling that shape India M&A today, and what are the clients most attuned to? Anuj, feel free to go first this time. Sorry, Indranil.
I was just thinking maybe Anuj would want to step in before me this time.
Sure. I mean, I would say it's the India multi-alignment strategy that we are aware of. India is maintaining this multi-alignment strategy with the US, EU, Middle East, Japan, South Asia, and continues to manage its China exposure very carefully. And that continues to support a very sustained interest in India across asset classes, and we continue to see robust deal activity. If there is one geopolitical trend which I think has a lot of untapped potential, it is the India-China corridor. There's enormous commercial synergy between the two countries, especially in areas like EVs, renewables, manufacturing. While political tensions persist, we are starting to see some signs of calibrated commercial realignment there. We saw JSW's deal to acquire MG's assets in India. We've seen Dixon Technologies do a few deals with Chinese OEMs to manufacture phones. If I one corridor with a lot of untapped potential is this one corridor, the India-China corridor.
I'm glad I asked you to go first. It's a good segue for Indranil coming from KWM.
Yes, indeed. I was exactly
I stole a little bit of your thunder, Anil. Sorry for that.
no. That's a good preview. So for the uninitiated, our firm is headquartered in Asia, and we've got 8 offices in China. And so China is a big part of what we do as a firm. And as Anuj has pointed out, it definitely is something that we are watching very closely because of the difficult geopolitical environment that we've been in till now. Um, so the flow both into China and out into India has stalled for a while, but we are seeing thawing of relations in various quarters, and there is more than just talk about the activity being reignited. So we are very hopeful for that corridor, and EV sits in the heart of that activity with the likes of Byte, for example. They're very acquisitive in Asia, more regionally, and India definitely is one of the markets that's in a way slightly little bit behind on the EV curve, but with a lot of potential to scale up. And we are seeing that across our client base. We are currently raising a big fund, which is focused on the EV ecosystem in India specifically. So that definitely is a sector to watch. And just to probably add, and again, Anu just covered everything quite well. Very little to add. But what we are also seeing is that's hopefully will drive more deal flow in India is climate diplomacy, as I call it. Climate financing commitments are becoming, geopolitical tools. The India renewables sector and the hydrogen platforms are seeing more and more inquiries and real interest and real transaction. Obviously, Brookfield has been very active in India on the ground, but there are other players who are making inquiries, and we hope it sort of fits into that energy transition theme, and it will lead to a lot of deal flow into India. Back to you, Ravindra.
Thank you very much, both. Very interesting points The way I look at it, India clearly remains a priority market, but it's interesting how sectoral tailwinds and geopolitical balancing or rebalancing, if I may, are shaping what kind of deals we are seeing. It's also clear that global shifts, whether political, economic, or policy driven, are becoming more closely linked to how cross border deals are being structured and timed. Uh, moving on, the excuse me, the third question, and Karun, if I can bring you in to the $1 million question, or in some cases, the $1 billion one. Deals don't fail in a vacuum. They trip over misaligned expectations, hidden red flags, or a we'll fix it after signing mindset. Delighted to hear your top three deal killers. And if you've got perhaps a good war story to share, all the better. Karun, and then maybe if I can get Anuj in also. So, Anuj, if you don't mind starting to think about a war story. Karun?
I think that is the billion-dollar question in these days, right? Why are M&A deals failing? Look, I think from an international investor's perspective, I think it's very, very important to understand the jurisdiction that you're walking into, right? So you got to understand country-specific risks. How do you understand them? How do you mitigate them? Those are very, very key elements for a first-time investor or a first-time acquirer walking into India. So the mitigation steps obviously are due diligence, like undertaking due diligence properly and efficiently, and understanding the risk reward with certain holes that may be there in the target's businesses, in terms of whether it's licenses or approvals, etc. So for that, I think it's super important for international investors coming into India to get proper advisors. Either it's the investment banker, either it's the tax advisor or the legal advisor, who can sort of give them the balance, between what is perceived to be an egregious situation at the company's end or at the promoter's end, and what is something that they can solve for. How do you solve for that, right? So I think that is super key for investors and acquirers coming into India. Now, some of the reasons why, despite having the best advisors, things can fall apart is, there's either a lack of transparency with what the commercial outcome of the target ought to be. I think you touched upon one very important point, which is, board rights. Why is it that the acquirer doesn't get full control over the board? For example, when the target entities promoters say that they need to have a little bit of oversight for a certain period of time. Now, typically you have earn-out processes which are put in place where you incentivize the management over a certain period of time to, attain certain milestones, achieve certain EBITDA targets. So in order to sort of control the narrative and to control the company in order to achieve those milestones or those EBITDA targets, management typically says that, look, at least for the first 2 years or 3 years or however long the earn-out periods are supposed to pan out for, they need to have overall control because they know the business, they control the business, they know who their suppliers may be if that's in the manufacturing space, they know who their customers are, they know how to manage the business. That, obviously there's a little bit of tension there, especially if you're acquiring total control over the target, because an acquirer obviously wants to know what's actually under the hood in terms of that target, right? So I think that's a super important discussion to be had upfront. I think that's super important even at the term sheet stage to make sure that the international investor knows what they're getting into and what their control rights would be. The other is obviously understanding the financial statements. When you walk into a company, typically promoters are not prepared to open up their kimono, so to speak, to give you all your secrets, all your IP, all of your sort of know-how, intelligence that you've gathered over, whatever number of years that you've been operating. So I think it's important to understand how you manage those expectations also, especially when it comes to financial statements. It normally takes about 2 or 3 audit cycles for you to sort of decipher whether there's anything materially misstated in those financial statements. So those are also post acquisition sort of issues that you deal with. There's obviously, the biggest word on the street these days is integrity and integrity due diligence. Were there certain issues that they didn't know about management that needed to come to the fore during the acquisition stage? Those are also causes for why transactions unwind. These are all sort of like the headline sort of issues, but even beyond that, from a pure legal perspective, in India, we do have this rule now which says, it's called Press Note 3, which says that if you are an investor that shares a land border with India, then you need to obtain prior Reserve Bank of India approval. People have to factor that approval in place. This approval is obviously it's something that we've been able to obtain for some of our clients, but it's a process. And for an acquirer who's in a hurry, I think you need to educate them that there is a sort of process that is involved. You have to go to the RBI. It's an iterative process. It's not like you put in the application and the application comes back within 6 months with with everything is okay. There are questions that are asked, so it's a repeated, getting in front of the regulator to address those issues. So you need to understand that. National security, I mean, for an Indian acquirer looking to acquire targets overseas, including, say, the US, you've got your Committee on Foreign Investment in the United States, or CFIUS. You need to obtain approvals if it's a particularly sensitive area, such as defense, or supplying any sort of intelligence to defense. So you need to actually factor those issues also in place. Then the biggest question is, if I'm acquiring an entity, 100% of it, non-competes. How do I make sure that my non-competes are enforceable? How do I make sure that the key management that we're buying the business of are not going to sell it to us and then, start another company the next day? Again, relying on your expert advice is super important, because I can tell you that, there was a particular situation where they were looking to acquire a target in California, and one of the key elements of that transaction was the non-compete. Is it enforceable? How quickly, how robust is my non-compete agreement with these particular promoters or the key management? And we found out, much to the management surprise, that non-competes in California are very, very strictly, regulated, in the sense that it's one of the most difficult parts of the world for you to enforce a non-compete. So this was a bit of a surprise, I think, from one of my clients. And the others, of course, managing labor, union issues. If you're going into a manufacturing entity, especially in Europe or in certain other jurisdictions, you need to make sure you have adequate time for you to manage the union and their expectations with new management coming into place. So these are kind of the broad strokes issues that we've seen and we've dealt with some of our clients, including for internationals or Indians looking to go abroad.
Super, Karun. Anuj, would you add a few?
Yeah, I can add. Yeah, sure. And some of it overlaps with what Karun says. But Rabindra, you asked me uh,
War story.
for a war story, and maybe I can use one from my own deal where we worked together. And this was a European client which was evaluating an investment in an Indian NBFC. During the diligence, we find a large number of related party transactions, which is not very uncommon with Indian companies. Now, the transactions were at arm's length, certified by the auditor, and arguably also in company's interest. Uh, but what spooked, so to say, the investor was the lack of rigor that was followed in the process to do these RPTs. Uh, this lack of overall transparency with the process really, made the investor nervous, and the deal did not go through. And maybe I can share another one which is again linked to Press Note 3. We were working for a large European company again, looking to set up a financial services business in India, a JV situation. And it was just because of some PN3 China exposure on the target side, on the joint venture partner side with whom we wanted to do this GV, the approval process just even after 18 months of waiting for approval, nothing came through, and it was not even a rejection, it was just silence at the door of the regulators. So it kept on dragging for 18 months. All other terms were closed, but finally the deal had to be abandoned. So I thought I'll share some of these stories and broadly the sense, some of the examples of Karun and the ones I put forth give an idea that it is very important to get right the deal architecture at a very early stage and evaluate these blind spots. Thank you.
Thank you both. That's exactly the kind of insight deal makers who are attending need to hear, and I can tell you by the count, very many of them have logged in today. I asked for three each. I asked for a war story, and we've got so many more. So thank you very much. Clearly, it's not one big issue, but the silent buildup of misalignment or overlooked risks that derails things, and we need to be mindful of that. Another comment that I would probably make at this stage is, it's a very strong reminder from our speakers that chemistry, clarity, compliances are equally vital. So please keep that in mind. Uh, a quick note to so many of you who are attending that your questions, which I'm getting, will be taken up, perhaps maybe towards the end, because I see a lot of overlap between what we intend to cover. So we will cover it. Please bear with us. Um, Indranil, I don't want you to be left out of this discussion. So let's flip the lens to foreign investors. What are the diligence areas in Indian deals that tend to get missed or underestimated? And are there any quirks that deserve a sharper focus early in the process? So, from your perspective, if you would like to add a few things, you'll have to unmute yourself, Indranil. Sorry, you'll have to start again. Unmute yourself. Thanks.
Sorry. Thank you for that. But I was going to say that the themes are very similar. One of the most important things that foreign investors coming into India look at is exactly what both Anuj and Karun have spoken about, is promoter-led structures. So in often these governance structures mask you've spoken about the related party transactions, intergroup liabilities, shadow influencers, and it's not reflected in the public filings. And there's a couple of examples that we've come across. We had a transaction where foreign buyer discovered their supplier advances in the balance sheet and in fact were undisclosed loans to promoter linked affiliates. So this only emerged on the financial DD side because they did a deep dive on the intercompany ledger and cash flow journals. But then it flipped onto us because there was an issue that needed to be dealt with in the documentation, and we had to negotiate hard indemnities and a sizable holdback. So while this is one of the top issues that foreign investors coming into India look at, there was another deal with a Japanese conglomerate looking into entering into a joint venture with an Indian promoter. So we were on the transaction side and there's a legal diligence being carried on, but in parallel there was promoter specific diligence being carried on by the client. So while we were having discussions around all of the legal due diligence pieces, and then we had made a start on the transaction documents, and then the deal aborted because something completely unbeknownst to us. And on the deal side there was a sponsor-led sort of a due diligence issue and a reputational impact. That's something comes up quite often, is the reputational impact from foreign investors. And that has played out in some ways, as we've seen from some of the experiences that the Canadian pension funds have had in India. So that's definitely top of the list. The other one is regulatory. It's and the way we see this is there are two buckets of jurisdictions, and India falls into one of those buckets. So Asia, you can see Japan, you can see Korea, you can see Australia in one bucket. It's like more developed Asia, and then you've got Indonesia, Vietnam, Philippines, and India is somewhere in between, and the regulatory piece is quite important. It's a highly regulated jurisdiction, and in sectors like, for example, we've got these unique issues that we've come across at tech, fintech, healthcare. There are businesses that are running on provisional approvals, and in a tech type acquisition that we did recently, there was a we discovered that there's a NCT accreditation that wasn't uh, taken on, and then we had to grapple with whether it should be a CP or a post-closing covenant. So that regulatory is a big one. Land, environmental risk that needs to be that also comes into quite often. And I don't want to take up too much of the space, but the other one is quite interesting. Is ESG related. It goes back to the climate diplomacy. It goes back to the central themes about around environment and ESG specific factors. What we are seeing with some of the DFI type of clients when they're investing into targets in India, or whether directly or indirectly, their ESG parameters that needs diligencing in terms of how the ESG policies are being implemented and how the parameters are being implemented. That's also coming through as a theme more and more. So I'll just pause there and give it back to you.
Super. Thank you very much. All very well put. We have seen Indian diligence often throw up surprises in areas like irrigation, title, tax. So clearly, front loading scrutiny there can save a lot of heartache and headache later on. There are a few questions which are coming up on the regulatory piece, and perhaps maybe Karun, you raised regulatory PN3. Perhaps maybe that was a trigger. So if we can spend, very quickly take this question and a few others, combine it. Uh, the famous alphabet soup, FEMA, CCI, SEBI, RBI. And if you can very quickly cover what are the unexpected curves and regulatory issues that foreign buyers never see coming until it's a bit too late, and whether RBI or government clearances prove to be pain points, especially in sensitive sectors or deal which involve certain countries. Anuj, maybe if you take that and very quickly, because I know we have a few more questions to cover.
Yeah.
You want me to start with the pricing?
Go ahead.
Maybe I'll start with the. So I think the biggest issue that yes, of course you do have the PM3 CCI, all that more sort of set in stone. Other jurisdictions have some of these issues as well. But I think the one issue that really flummoxes foreign institutional or foreign investors when they come into India is our pricing guidelines that you have under your foreign exchange management rules, right? So sales of shares by a resident Indian to a non-resident cannot be at a price that is lower than the fair market value of the shares of the Indian target. So this is quite fundamental that they need to wrap their heads around. This has certain cascading effects into other aspects. Depending on whether there's a structure for some of the management to have a stub stake in the target post acquisition. The pricing guidelines also complicate post acquisition issues such as the implementation of ROFO, ROFR, tag, drag, and put options. Right, the pricing guidelines are still very much in play after you acquire the target, and if any of these scenarios were to play out. For example, in a tag long ride, if the price at which the shares are proposed to be sold by a resident to a third party who's also resident is more than FMV, then the third party resident will not be able to buy shares from the non-resident because of the pricing cap. So there's a pricing cap also which applies, where sales of shares by a non-resident to an Indian resident cannot be above the market. So there's a floor, like I mentioned before, and there's also a cap. So this is something that, when you explain it to foreigners looking to come into India, this is something that they need to wrap their heads around. The way in which, like I said, the ROFO tag along rights also is, certain scenarios where it comes into play. The other aspect is also how do you, one of the risk mitigation tools that we use is deferred consideration and indemnity holdback or escrows. In Indian foreign exchange regulations, deferred payments, including indemnity holdbacks or escrows, must be paid within 18 months of the payment of the full consideration. So this is an important element. So, like I said earlier, sometimes it takes 2 to 3 audit cycles for you to see where the sort of egregious or whether there are any, material issues in financial statements. Now, this 18-month period may or may not be enough for them to, have this deferred consideration or this indemnity holdback. The other factor is also that payment for this deferred consideration cannot be more than 25% of the total consideration. So, when you have a scenario where you're looking at an earn-out situation as well, all of this will be factored into deferred consideration. Whether it's 25%, that's the differential, and it all needs to be done within 18 months. So now, obviously, when there's an acquirer coming into India, 18 months and 25% may not be adequate. So how do you structure around that? This is where there's a lot of time which is spent with the client explaining certain structures that we've used. Some of those structures, like I mentioned earlier also, will be that the management then continues to hold a residual stake, and then you have certain milestone payouts, subject to them achieving certain EBITDA or revenue targets. So these are ways in which we can build for it. We can also do 100% acquisition and then issue, a convertible pref share or a convertible debenture to the management. And there again, you can incentivize them to, for the conversion rights to be sort of tweaked once you attain that EBITDA or that revenue multiple. So these are ways in which you get around these FEMA or foreign exchange management issues. But this is sort of top of mind when it comes to structuring an all-out acquisition in India. And maybe I'll let Anuj lead with some of the other the PN3 and other issues.
Should I? Yeah. Okay. Thank you. So I'll supplement to what Karun mentioned, but some of the issues that I see where deals trip often. Let's say, and I'll give examples. Let's talk about insurance, where we have a cap of 74% for foreign holding, which was introduced in 2021. We currently have a proposal to raise the cap to 100%, but it's yet to be operationalized. But despite regulations allowing foreigners to continue to own 74%, a lot of ambiguity exists over control and what rights would tantamount to control and what rights the foreign investor can have or cannot have. And then we see different precedents being followed in different deals, some right which was approved in an earlier deal being rejected in a subsequent deal. So we see a lot of ambiguity where sectoral regulators are involved, and that sometimes leads to deals not getting closed faster. The other interesting one I've seen panned out, which is really a global deal happens, and now we have antitrust laws which have been changed to provide for local thresholds. So Indian competition laws are triggered even if the local thresholds are met in global deals, and we have seen this in BlackRock GIP deal or UBS Credit Suisse or several other deals where the filings need to be made. We are aware of deals where sophisticated advisors missed out on the India filings, and then the entire deal at a global level got stuck, or they had to be scrutinized and filings have to, compoundings have to be done with the regulator. So that's one piece. Similar parallel has existed for a long time under the takeover code regulations, which is our laws provide that even if there's an indirect change of control of a listed company at whatever level, and the thresholds are prescribed, it triggers an offer in India, and we've seen that missed out in the frenzy to do global deals sometimes. And then something, it's that same story of a stitch in time can save nine, and then it takes forever to go back to the regulator and get these things sorted. The other one, outside of FEMA and foreign exchange laws that we see often, is around land acquisition and employment. I thought I should touch on that because land is one of the most overlooked challenges in Indian M&As. Land is governed by state-specific laws in India. The records are often unclear, and it takes a lot of time to get comfortable around land title. Similar issues exist around employment. When we see a lot of deals now which are very employee heavy. It could be a US company with back offices in India. We see a lot of those deals on the SaaS side, and we see significant compliance challenges because we continue to have state-specific labor laws in India. Rarely do companies engage a single service provider to manage all employment law obligations, and it leads to fragmented compliance practices, and that is again another issue we see become very complex in several deals.
Super, absolutely. Can't agree more. And many buyers underestimate how the India regulatory landscape can shape and reshape a deal mid-course. I had China in my mind because of PN3, and we've seen how many hit a roadblock, and you need proper set of advisors. So the clear message is the earlier you loop in advisors, the smoother the landing. Uh, it's a complicated market, but if you have the right set of advisors, you can very easily navigate it. Uh, I am getting some questions on indemnities, caps, baskets, etc., but I'm going to move on, take that up later. One thing which I really wanted the speakers to cover is look at the cultural side of negotiation. Just to give you context, there are a lot of attendees who are logging in from overseas, and there are many who are on the Indian side as well. So, Anuj, if I can bring you in for this question, how do you bridge the gap when a global investor is engaging with a promoter-driven Indian business? Where the style, the speed, the structure, the advisor can be quite different from what Indranil may expect. So, Anuj, if you can go first on this one, please.
Thank you, Rabindra. Clearly one of my favorite topics. And this is where we say within KCU, and we've used that term, that this is where law meets anthropology. We know that promoters-led businesses in India are often multi-generational. It's deeply personal and run with a very strong sense of legacy. I can give examples. In one of the deals we worked on recently, a Singapore-based acquirer was purchasing a family-run packaging company. The deal nearly collapsed and despite it being almost a control deal, the deal nearly collapsed until we agreed to co-brand. Even despite the acquisition, the old brand name continues because the family exiting was still so passionate about their last name or names associated with their family to continue on the brands, and that concession had to be made. Despite the control acquisition, ceremonial non-exec chairman role continued with the exiting family, and only with those concessions the deal went ahead. But it can also cut the other way too. We have seen deals where promoters have retained a small post-closing stake. We know of an instance where the promoter felt disrespected and not being treated fairly during the negotiations. Just after closing, he disengaged. The key employees followed with him. The integration failed, and it was a failed deal. Let's say hundreds of millions of dollars wrote off for the investor. So there's a huge cultural alignment which is needed. There are other examples in public. I'll just touch on that quickly. We know about these edtech firms when they were loaded with money, they went on a buying spree. They acquired some company. Again, it could never be integrated, but a lot of it was cultural misalignment. And as a part, the last point on my list is, but all having been said, there are very, very good examples of companies like Tata Singapore Airlines or Toyota Kirloskar, where mutual trust has weathered operational turbulence, and people have both sides have given it the time to build trust, and they continue to function very seamlessly. But I hope I was able to communicate this.
Spot on, Anuj. Clearly, deals with Indian promoters require softer skills and relationship building, and understanding how decisions are really made can make or break the negotiation. Indranil, if I can move on to you, and time to get candid. How does India stack up when it comes to deal timelines and execution, certainly compared to what you're used to in other major markets? What's better and what's still lagging? And perhaps, if I can ask you to be as candid as possible, uh, we know everything is not perfect. Sorry, you left. Yeah, thanks.
Realize I was mute. Thank you, Ravindra. But yes, I'll go back to that theme of having the two buckets of different jurisdictions. And we see deals across both buckets. So if you were to compare India to Singapore, Australia, Hong Kong, and some of the other jurisdictions on the western side, UK. So yes, definitely, it's much more difficult on the Indian side comparatively. But if you were to compare India with Indonesia, Philippines, Vietnam, more of the less mature jurisdictions, there are certain common themes why it takes slightly longer for Indian transactions to execute Indian transactions compared to others. And then the first is we keep talking about is some of the regulatory timelines can be very variable. And Karun mentioned the FEMA part of it, but there are for countries like India, Indonesia, Vietnam, where there are FDI is still an important part of the regulatory landscape when it comes to M&A in sectors like defense, telecom, or education. Uh, Even if it comes under the automatic route, there are some significant delays that we've seen with banks and intermediaries often applying some additional scrutiny and soft deadlines, which slows down execution. And we've already spoken about promoter-led businesses, and they can create certain invisible hurdles and decision bottlenecks. Who is actually taking the decisions? What level the decision is being taken? If you're doing the deal, and whether there are certain other decision-making levels that we have to run through, which creates certain invisible hurdles that we've seen that can derail timelines. Then there's less clarity on liabilities, tax exposures, litigation, regulatory show cause notices might come up. That transparency thing that Karun mentioned at the very outset is they might come up only late in the process, and that impacts pricing, it impacts escrow mechanics, it impacts RWI feasibility. But that said, things are improving. We see some of the things that we're seeing now is early pre-term sheet workshops being more common. So to align on regulatory, structural, tax issues in deals where we've got Singapore related structuring, it's more efficient and dispute resolution is clearer. Execution certainty is also higher when there's more professionalism on the promoter side, and it's less personal and less emotion driven. Particularly in tech, we see that, and digital infrastructure sectors. So it's becoming more faster and more standardized, and we have those contingency structures in place. And what we do with a lot of our foreign clients is have workshops pre-deal and to get them familiarized with the what to expect type of workshops, which definitely bridges the gap um, between what they expect and how do we manage deals.
Super. Thank you very much, Indranil. Very consistent with what we are seeing too. Timelines are definitely improving. Of course, they still rely a lot on regulatory predictability and sometimes sheer persistence, sprinkled with some luck. I have a question from the audience, and obviously this is from the Indian audience. Um, Karun, if I can bring you in, you've done a lot of outbound matters in different parts of the world. The question, if I can reframe it, essentially is when Indian companies go outbound, what are the most common issues that they face? What are the blind spots? Perhaps maybe two or three quick ones, if you don't mind responding to that.
Yeah, absolutely. Look, I think Indian acquirers have become very sophisticated in the recent past. They understand that they're walking into a foreign jurisdiction, so I think they're very comfortable with getting the right set of advisors to help them out. I think fundamentally, though, there are certain nuances which they need to understand. While, for example, the structure of the transaction, right? So in the US, we were doing a IT related acquisition recently, and the way in which we were looking to do the acquisition was a reverse triangular merger. So understanding what that entails, understanding the tax impact, understanding the sort of approvals that you need in order to go through that structure, that was a significant learning for the acquirer. But once they got across that sort of learning curve, I think it was smooth sailing. The other is understanding which jurisdiction and what the norms are. Say, for example, you're looking to do an acquisition in the European market. It's more typical to see a lockbox structure there. Understanding what that agreement looks like, as opposed to going into the US where you've got purchase price adjustments, what that entails. Those are certain areas where, obviously finance gets involved quite significantly. You have your investment advisors, investment banking advisors also who advise quite significantly on these aspects. Then again, like I mentioned before, the non-competes, how do you make sure that the key management does not compete, and how do you put guardrails against them competing with you? Certain jurisdictions can throw surprises, so you need to be aware of that. And then the last bit, of course, is the national security concerns, like we talked about CFIUS, FIRB, FIRB in Australia. These are all matters that we need to consider.
Excellent. Thank you very much. Another question which is coming up from the audience, it's tax. So, Anuj, I'm going to ask you to give your quick thoughts on it. Uh, what are the pain points? What can come back and hurt you later? When do you bring the tax team in, and what's the worst that can happen when they aren't involved? And I'm talking of a specialist tax team.
So, I mean, cross-border deals, as we're seeing again and again, tax structuring is become extremely critical. The tax advisors are getting involved in matters at a very basic structuring level, early stage. Uh, Several issues need to be assessed right as we start evaluating the deal, including whether the seller can access treaty benefits or exemptions. The tax advisors need to assess the withholding tax obligations, whether it falls on the buyer or not. The instrument through which the investment is sought to be made, equity, debt, hybrid, all of this could have different tax implications. Uh, Transfer pricing, again, we've seen there could be a lot of impact around transfer pricing and whether the deals are being done at fair market value. We have these rules where if shares are sold below fair market value, there could be a tax exposure. So all in all, Ravindra, to answer your question, and as we often do in our deals, it is it's absolutely vital for Indian deals to bring in the tax advisors right at the initiation of the deal alongside the lawyers to get the best results.
Couldn't agree more. And Indranil, I'm going to come to you, so maybe you want to unmute yourself. Anuj, these insights make it painfully clear. If tax comes in post term sheet, it's usually cleanup and you haven't planned it well. Getting it right early saves time, cost, and quite often face and the deal. Uh, that's the response to the audience and the person who asked that question. Uh, Another one
If
which
I can, because you used that statement, I got reminded of what one of our tax partners says, that if you bring us in later, it's like buying fire insurance after the fire has happened. we have a partner who often repeats that, and I think it is we've tested it, we've seen it unfold again and again, and exactly in the same spirit, Rabindra.
Absolutely.
That
No, lovely. I have a very interesting question in Indranil I'm going to ask you, and then perhaps Anuj, I'm going to move to you. Very quick input. It's a very interesting question, and I like it. Thank you for asking that question. First overseas acquisition is always the most exciting and sometimes the most painful. Uh, and the question is, if you had 30 seconds with the CEO of a mid-sized Indian company looking to acquire overseas, what are the three things that you would tell them to absolutely get right from the start? I want Indranil for you to tell me one thing and Anuj to tell me the second. We have a few more questions and we are running out of time. So one thing, please.
So I'll keep it very, very, very basic. I think what we've seen is going outbound, Indian companies, they focus on valuation a lot more than planning. So it is very important to focus on the strategy and have a clear acquisition rationale. What are you actually buying? Are you buying market access, IP, regulatory license, or diversifying your base? And so avoid being reactive and opportunity led without a plan to integrate and scale. So the real pain comes after you've done the deal, and then you realize there's a big gap in terms of your systems and the systems of the targets that you're acquiring, in terms of your culture and the culture of the team that you're acquiring. So have a clear rationale and strategy in place. Focus on that more than valuation.
Anuj?
if there's only one suggestion I have to make, I would just overemphasize on getting watertight agreements, very simply written, very articulate agreements. These contracts get enforced uh, very easily in many of the jurisdictions, and we've had situations when we've gone and tried to enforce the contracts, and you have the most seasoned arbitrators sitting there, and nothing makes sense. There are too many annexures, too many provisos, and everyone's trying to interpret, and several interpretations are possible. That is not needed. We can keep it fairly simple, uh, and that could save a lot of pain.
Solid advice both. And for mid-sized companies, the first overseas acquisition can be very transformational or overwhelming. So, getting clarity on strategy, assembling the right set of advisors, thinking about integration from day one, it makes a big difference, between a bold move and a misstep. So, thanks for those insights. Um, we never complete without asking a question on dispute resolution. It's always a hot potato. How do you align expectations on governing law, jurisdiction, or arbitration, especially one party is in India and the other isn't? Karun, would you like to go first on that?
Oh, yeah, absolutely. Look, I think dispute resolution is super key. Especially when you've got an Indian entity which is acquiring targets overseas. You have to understand where the assets are located, where the management is located. So then going by that, some of the nuances of what you put in your agreement will also be determined based on what the governing law is. So if you're undertaking a US acquisition, it's always advisable to have US law being the governing law, and making sure that people, those jurisdictions have the wherewithal to understand what the various permutations and combinations of what you've put into the agreement are, and arriving at a sort of middle ground, hopefully, for the Indian target. For internationals looking to come into India, like we've all been talking about, there are so many regulatory hurdles that you need to jump through. You need to have the governing law, which is determined by Indian law, and that just makes it easier for people to understand what the regulatory sort of issues are for you to sort of address the dispute, so to speak. But arbitration, increasingly almost 95%, if not more, of our acquisition agreements have SEAC arbitration clauses built in. It's one of the reasons why we also have a SEAC specialist sitting with us in Singapore, is to address primarily these concerns. And I think we're increasingly going to see this trend, just get stronger and stronger.
Excellent. Anuj, if I can draw you in, because I know you have fought some tough battles here. Any thoughts?
Again, yeah, absolutely. Thank you for that question. And again, my favorite continues to be simply written contracts. Every time, being a corporate lawyer, I've been involved in some of the contracts which got arbitrated, and it was always a struggle to relay what the contracts meant to reinforce. But in addition to that, I would also say on the procedural side, it is always important to ensure that interim relief under Section 9 of the Arbitration Act is preserved. Uh, we have to be mindful that countries, let's say UAE, and I've seen these mistakes, is not party to the New York Convention. So the awards from UAE cannot be enforced in India. So these are again some loopholes. Cross drafting, I touched. An infamous or a famous case is Anupam Mittal versus Westbridge Ventures. We all read about it, where there was a lot of ambiguity over which law governed the arbitration agreement. And it led to proceedings both in India and Singapore. So there's a lot of care which has to be brought into when drafting the dispute resolution provisions.
Excellent. We are drawing close to our end time, and there are a lot many questions which still require to be answered. There is there are a few on PN3. We have discussed this. We've covered it in a fair bit of detail, so I'm not going to go into the specific of the question that you've asked, sir, but happy to respond to it later. One which I would want to throw to the panel is, what are the critical success factors in preserving value and synergies after the cross-border acquisition is closed? And I don't know who wants to take it, but I thought it's a great question because we've talked about pre, during. Here the question is, what's the success factor in preserving value and synergy after the cross-border acquisition is closed? Any one of you?
I mean, I can go and then my co-panelists can agree, but add to it. But I think it is clearly the integration part of it. We see it often. I've been practicing it for about 20 years now, and this is one area I still hope we see more changes. But the condition subsequence, once the deal is done, and Ravindra, you mentioned at the start of the session about the champagne getting opened, but once the signing is done, monies are paid, deals closed. Generally, the rigor that needs to be followed on condition subsequent is not applied. Integration goes haywire, and I think that leads to a lot of confusion, misalignment of interest between the acquirer and the target company, the ultimate assimilation. So a lot of plans get derailed after the acquisition, and I would think that integration is one part I'd like to highlight if I have to just pick one.
Thank you. I'm not going to ask others to add to it. A yes and no, do you agree or not agree is good enough, because I still want a few questions to be covered, very good ones.
Okay.
Absolutely agree with that. Uh, top, top, top priority, cultural integration, just integration generally post merger.
Absolutely. Yeah.
I didn't have any doubt, but I thought I'd still ask you. Indranil, one of the questions which came up earlier and I skipped, this is more about indemnities, caps, baskets. Uh, Perhaps maybe if I can ask you, how do you see risk being allocated differently in Indian M&A deals versus a global practice? Any quick thoughts on that? I thought it's a good one.
Yeah, it's not very, very different, right? You've got your uh, basket, you've got your de minimis, and you've got your caps. It's just what falls in under on what categories. So you can have your 0.1, your 1%, and 10 to maybe 20%. But what is it that we are capping? Are there are certain clear rules around, say, capping fundamental warranties, so that usually uncapped or capped at the purchase price, and business warranties, what's getting capped. What I do see when we do Indian deals is a difference in style. Uh, For example, on the UK side, we've got indemnities, for example. It's not used on a wholesale basis. It's used only for very specific deal-breaking diligence issues that are known, and it's very targeted. But on the US side and more on the Indian side as well, warranties are given on an indemnity basis, and there's hardly a difference between a warranty and an indemnity. So it's not as the risk is not as elevated. So there are different styles of doing deals, but broadly speaking, the rules are same, and there are many variables as to how the risk gets allocated. You've got your escrows, you've got your retentions, so it's very similar, but there's some nuances as to how the deals are actually done on the ground.
Thanks very much, Indranil, for the inputs. I'm going to do a quick wrap up and talk about only a few takeaways. Clarity beats charisma. So you know why you're doing the deal, not just how to do it. There's a tax and regulatory surprise which love to hide in plain sight. So bring in your advisors early and never underestimate the local nuances. There's a culture and communication which are important, which make or break. So the deal is not just on paper, it's in people's hands. So if you remember nothing else, remember this, that cross-border M&A is not about getting the deal done, but it's also about making the deal work. Those were my key takeaways from the conversation. Before we wrap up, uh, here's the time when I ask the audience to do some work. IT, if you can put up the poll, please. There's a poll slide which is going to pop up on the screen. We take feedback very seriously. Uh, Please, if you can take a quick moment to give your feedback, we would love to get your thoughts. It helps to improve our session and keeps our team active and up what we need to do. So it's on the screen. It should be on the screen. If you don't mind quickly responding to that. And while we are sort of doing it, perhaps maybe I can just run through a few housekeeping points. Um, we will send you the copy of the presentation. We will send you some notes. We will send you the recording. So please feel free to revisit it. If there are some questions which haven't been answered and you would like us to attend to it, feel free to raise it. Thanks to everybody who participated on the poll and for keeping it anonymous. So we don't know who didn't give us full marks for that. But most importantly, Indranil, Karun, and Anuj, a huge thank you. You've not just shared your insights, but your war stories, practical tips, and a good dose of humor. You are outstanding. I can't help but thank the team at the background who does such a lot of work. Thank you for your questions, audience. The curiosity was fabulous, and of course, your time. We will send you separately a feedback form, just a few questions, less than 30, 60 seconds. Tell us what worked, what didn't, and we'd like to very much see you at future sessions. So if you want to continue signing up for these webinars. Uh, if the session sparked thoughts about in-house training, or if you want to dive deeper into anything we discussed today, feel free to reach out. You have our details on the slide. We will send you something as well. Once again, thank you for spending this hour and few minutes being with us. Look forward to seeing you at the next M&A Academy webinar. So until then, happy deal making and have a great rest of the week. Thanks all again.
Thank you.
Thank you.